Now that the Federal Reserve has launched an open-ended third round of bond buying and said interest rates will remain at zero at least through the middle of 2015, the global hunt for yield has kicked into high gear. So what are the implications of QE3 for the bond market, and where do you find yield now? Here to weigh in are Wlmer Stith, co-manager of Wilmington Trust's short-term corporate bond fund, broad market bond fund, intermediate-term bond fund, and short-duration government bond fund. Don Quigley, portfolio manager of the Artio Total Return Bond Fund, a 4-star rated fund by Morningstar, and Adam Patti, CEO and founder of IndexIQ. Gentlemen, welcome to the program. I want to talk about how the bond market is responding to QE3. We initially saw yields on treasuries move higher after the announcement, but yields have since come down. Will, in theory, you'd think yields would stay down and that would prolong the 30-year bull market in bonds. But is that how it will necessarily play out?
We don't necessarily think that's exactly the way it's going to play out. We think the greater correlation is going to be with 30-year and 15-year mortgage rates. Right now, 30-year mortgage rates are about 3.5. We think by the time spring rolls around, it could easily be at that 3 1/8 to 3 1/4, which would really add a lot of power to the housing market.
I have in my notes, Will, that you do expect a higher interest rate environment as we get into the beginning of next year. Is that correct? And if that is the case, what does that mean for investors in bonds?
Well, we think that is the case. We think housing will start to pick up a bit because of QE3. We're seeing signs that the wealth effect of housing is increasing. It's buoying consumer confidence. New home starts are still well low from their peaks, but are headed in the right direction. So all of this should lead to stronger GDP growth. At the end of the day, the major determinant, in our opinion, in terms of the sectors of the bond market is going to be influenced by when the Fed is going to start taking back some of those QE measures that they put in place. So if we get into 2013 with a 2 to 3% GDP growth, with unemployment closer to 7%, well, I think the market will then sort of recalibrate as to when the Fed is going to start peeling back some of those quantitative easing measures. And quite frankly, it could be well in front of the middle of 2015.
Don, what's your take? Do you think that the 30-year bull market in bonds will be prolonged as a result of QE3, or do you think the bond vigilantes come in here anytime soon?
Well, it really depends, and I'm sorry to be kind of ambiguous, but it depends on how the economy does. If you feel there's going to be inflationary pressure, it doesn't matter. If the Fed is only going to be buying $40 billion a month, it's not going to be able to hold interest rates down. If they said, okay, we're going to really ramp it up. But if inflationary expectations start to rise, that's the big risk with a quantitative easing program. I don't think the vigilantes are really worried yet about the inflationary pressure that I was talking about. It's not entering the American psyche yet. Simply wage inflation is going to be held down for a while.
All right, let's talk about where to find yield now. The Fed has said that it's going to be purchasing $40 billion worth of mortgage-backed securities until the labor market improves, and perhaps then some. Don, does this mean that you should be purchasing mortgage-backed securities as well?
Sure. Well, we already do own some, and we think that they hold decent value. I mean, they've had a good rally when the Fed made their announcement that it's quantitative QE infinite, if you will. So that's going to be helpful to the mortgage-backed securities. You're going to see them rally versus treasuries, but there's going to be a point where, all right, they might not make sense because of the convexity characteristics. Basically, what happens is if the interest rates do go up, these bonds will badly perform. They'll perform terribly. So you want to be careful just how much exposure you have over the longer term.
Well, within the U.S. bond universe, where are you finding yield now?
We think on a relative value basis, investment-grade corporates is really the most optimal sector. There's the largest technical condition that we've ever seen in corporates, and that's being driven by these QE3 measures, QE2 and Operation Twist, and it's sort of forcing investors that were perhaps buying treasuries, maybe agencies, to look to higher yielding sectors of the bond market. And now, with the latest, they're buying, $40 billion a month in mortgages. That's just exacerbating investors' need to look for other areas where they can find a higher sustainable yields and income. And investment-grade corporates, we think, fit that bill.
Yeah, well, what about high yield? Because we've seen a lot of investors piling into that space, searching for yield in this low interest rate environment. Spreads have really come in. Is the space actually too expensive now, on the verge of frothy, in your view?
We think it may not be frothy, but we think on a relative value basis, on a risk-adjusted basis, we prefer investment grade over high yield. High yield is up over 12% year to date on a total rate of return basis. The yield to maturity are almost all-time lows. The problem, a technical problem with high yield, in our opinion, is a lot of these bonds that were issued, maybe 3, 4, 2 years ago, have a lot of calls in them. And so while the dollar prices on these bonds have risen dramatically, there's a much greater degree of call risk in the high yield space versus the investment grade space. The other consideration is that you're starting to see new deals come to market with a lot less protection for bondholders. And we're also starting to see the beginnings of perhaps corporate deterioration in top line revenue and earnings projections going forward. So sort of all those things suggest to us that sort of the lily's off the vine as it relates to high yield.
Yeah, I was reading this morning, you've got a lot of companies that are coming in and taking advantage of all the investor demand, and these are companies that have sort of higher default rates, right?
Absolutely, they do, yeah.
Yeah, okay, so within the corporate investment grade space, are there certain sectors that you favor over others?
Well, there are, with regards to finance. In the finance space, it's a significant portion of the overall corporate bond index. And there we're taking a different strategy. And so we're shunning away from the larger banking area and really focusing on regional banks, banks that really stick to the knitting of lending deposit, lending, making loans, banks such as KeyBank, Comerica, Fifth Third. We also like in the finance space insurance companies that, are really good at pricing insurance risk and really are just, have a very sort of more simple business model than those much larger banks and broker-dealers.
Don, are there opportunities in Europe, and I'm not talking about the sovereign level so much, but the corporate level? Are there companies that are domiciled in Northern Europe that have strong cash flows, or getting their sales and earnings from Northern Europe or other parts of the world that are better off? Would you be investing in those sorts of corporates?
Sure. You can look at some of the multinationals. We've had positions, say, in Diageo or Pernod or Unilever. Those are the kind of companies that, yes, they're based in Europe, and so their U.S. bonds are going to be trading at a higher yield because they're tarred. But they shouldn't be, because a lot of their revenue comes from outside Europe, and then you are talking consumer non-cyclical type of credits. So you take that extra yield, you're able to sleep at night.
All right, Don, what about emerging market government bonds or emerging market corporate bonds? Are you finding yield there?
Well, we find that in the EM right now, we've got bigger positions in government bonds. We actually don't buy corporates when we go to EM. We've got positions in Mexico and Brazil. Mexican bonds we own in the longer end. So what we're doing there is we're going to buy the bonds. We're holding the currency as well right now. We're getting a yield of about 5%, but the bigger kick for us is going to be we expect interest rates in Mexico to continue to drop. The central bank has done a very credible job. We think that the government is going to continue to have fiscal discipline. Interest rates there will continue to grind down. It'll take time, but we're willing to wait because we're clipping that coupon. Brazil's a slightly different story, where we've got bonds in the shorter end, but we're getting yields of about 8%. Very attractive as long as we're holding the currency. We think the currency is going to be well behaved because the central bank has kind of signaled they don't really want a lot of volatility in the currency right now. They're going to lean on it if it rallies too hard, but more importantly for us, if it starts to give up, we think they'll actually come in and buy. That will be a big incentive for the currency to stay where it is.
All right.
Clip that coupon.
I want to bring Adam into the conversation. Adam, do you see opportunities for yield in real estate investment trusts, or are they just too expensive right now?
Well, it depends on what segment you are looking at. And firstly, thanks for having me today. The REITs have certainly had a nice run up over the last 18 months or so, and certainly the REIT market, or the real estate market generally, seemed to be bouncing off the bottom. But in our assessment, the best place to be looking right now is the small cap segment of the REIT universe. And the reason for that is because the large caps are really those companies that most investors are spending most of their time buying. What they're ignoring is the small cap, which are really the hidden gems in the real estate market. They're just more difficult to buy. There's not a lot of funds that focus on them, and most investors don't know them by name. And they happen to be providing, typically twice the yield of a basket of large cap REITs.
And we should know for viewers that you launched about a year and a half ago the IQ U.S. Real Estate Small Cap ETF, ticker ROOF, R-O-O-F. It's got a yield of about 4% and change now. What do investors need to know about investing in ETFs that track REITs?
Well, I think the first thing you want to be looking for is a product that is well diversified. Not only well diversified in terms of the sector allocation, which is very important. You don't want to have all your concentration in any specific sector like retail REITs or mortgage REITs, whatever it may be. But you also want to look at the top 10 holdings and what the concentration in the overall portfolio is. Many of the large cap REIT ETFs out there, if you look at the top 10 holdings, actually comprise anywhere from 25 to 40% of the overall portfolio. So you're really not getting a very well diversified portfolio of REITs there. What you're getting is the top 10, which may be good in some markets, but typically, given that those were also the more popular REITs, those are the ones whose prices have already been moved up based on market impact, because everyone is pouring their money into those.
All right, Adam, Don, Will, thanks so much to all three of you for being with us. Hope to see you soon.